is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London. Here's what's coming up on today's programme. Let down by tech, Asia stocks follow Wall Street into the red as a sell-off in Chinese technology shares intensifies. The dollar snaps a two-day decline. Face into the storm. UK Chancellor Jeremy Hunt delivers his highly anticipated budget statement today, seeking to stabilise the public finances amid economic headwinds. And the Ukrainian President Volodymyr Zelensky speaks to Bloomberg on the final day of the New Economy Forum in Singapore. He says the war with Russia will end only when Crimea and the Donbass are returned to Ukraine. So that's the geopolitics. Let's check in on these markets then. Very modest gains across the benchmark here in Europe of 0.2%. We're looking, of course, at what's happening in the UK. The FTSE 100 currently down by 0.4% as we lead up to that important autumn statement around 11:30 a.m. UK time from the UK Chancellor, and how it sets out the spending cuts and tax plans for this government to address a £55 billion fiscal hole. The futures in the US putting up by 0.2% on the Nasdaq. S&Ps on the S&P, even is the Nasdaq futures pointing up by 0.3%. The Bloomberg Dollar Index, you can see there a gain of about 0.1%. And of course, we keep an eye on the pound and gilts as well. Currently, the pound is trading just a little bit higher, about 0.1% higher this morning, 119 versus the US dollar. Gilts, not a lot of action. You've got a 2 basis point move higher in yields at the front end, 3.02. At the 10-year, you're looking at 3.14 on gilts. We continue, of course, to monitor UK assets as we lead up to that autumn statement. Now, a China tech sell-off led a slump in Asia stocks earlier today. Meal delivery giant Meituan fell after Tencent pledged to distribute $20 billion of stock in the firm. With us to unpack this and more, we have Bloomberg's managing editor for Asia stocks, Lianting Tu. We're going to get to that shortly, but the context is Tencent, of course, a major investor across the tech space, not just in China, but in Asia as well, pledging then to offload a significant chunk of stocks in Meituan, another huge delivery app, really another super app in China, and concerns from investors that this could lead to further divestments for a company, Tencent, which has really acted a bit like a major venture capital firm over the last 10 years or so. So, Lianting, is this the end of the rebound? We saw this aggressive rebound in Chinese tech at the early part of this week, or is it just a blip?
I think I'm leaning towards the latter. I think overall, we've seen a huge rebound in the Hang Seng Tech Index in the past 2 weeks, right? 35% gain. I think it's a reasonable time for people to sort of take stock, consolidate, take profit. And now, this week, we're seeing a huge amount of earnings coming out. And that is a good opportunity for people to actually look at the fundamentals to see if the rally is really supported by earnings and the outlook of those companies. So Tencent, as you mentioned, their earnings were actually decent, right? Revenue was a miss, but profit was a beat. And people were quite upbeat about their advertisement sales, which was very difficult in this environment. But they managed to eke out a little bit of a gain. And today we'll see Alibaba coming out. And I think the expectation is for a growth in revenue after their first dip ever in the last quarter. Things may actually look relatively good going forward if the earnings are able to sustain the rebound in tech stocks.
OK, important context looking ahead to Alibaba, such an important kind of weather vane and gauge of the sentiment in terms of e-commerce and sales there in China. Lianting, you're going to stick around. We're going to get a couple more questions to you, but I want to bring in JP Morgan Asset Management's Global Head of Multi-Asset Strategy, John Bilton now. Very pleased to say, joining us in the studio. Good morning, John. I want to start with China. We're going to get your views on the 60-40 portfolio. I know you've got some interesting views on that, and of course the Fed, and as we lead up to this budget or the autumn statement in the UK. But I want to start with China. Do you want to? Are you seeing enough now to be wanting to increase allocation to that market?
Well, look, I think we've seen that China is massively oversold. We saw that. We got a little bit of incremental good news on the property sector, a little bit in terms of zero COVID. And, you know, as your previous speaker mentioned, we've seen Chinese assets shoot upwards. But they're still deeply undervalued at the moment. And I think that's because there's still a lot of concern out there about, you know, where do we go with things like regulation? What is the fiscal stance within China? And what's the actual shape of pulling back from COVID zero going to ultimately look like? And I think as a result, there's concern generally around the globe in terms of thinking, at what point do I want to invest in China? So I think, look, if we look forward, China looks as if it could be, you know, a reasonably strong economy in the next 12 months, certainly compared with some of the concerns around recession in the parts of the world, such as Europe, such as the States. So is it something that we look forward to as being potentially an area we'd be interested in? Absolutely. But I think at the moment there's still quite a lot of cross currents that I think a lot of longer term investors are still watching.
OK, so you're not ready, maybe in 12 months' time, but you want to see a bit more concrete evidence of some of these changes to be able to really have the confidence to dip your toes back in.
Well, I think China's been hit pretty hard by a combination of things. Obviously, the regulatory changes in the tech sector, that the property situation, and of course, COVID zero. But there are some signs, if you look at some of the export data around the North Pacific Rim, beginning to show signs of a little bit of life. And, you know, clearly, as we start to see a little bit of evidence that we're moving in a more positive trajectory, then I think investors generally will begin to re-examine China. But it's very much been a difficult market, with essentially the economy partly shut down by COVID zero, to really sort of get a trend going in.
Lentin, let's bring you back in at this point, because inflation has not been a problem for Chinese authorities for many a month, and yet the PBOC coming out today saying, warning that maybe inflation is creeping up and concerned that that may hamstring them, at least restrict the ability for them to add additional stimulus and support for that economy. How much potentially is that a headwind for China going forward?
Yeah, it is quite interesting, and it's a bit of a surprise for investors as well, because, you know, inflation has been quite subdued. I think China's inflation is probably ranked at the lowest among major economies in the world. The signal definitely means potentially higher bond yields, right? And then we are actually seeing a little bit of a mini bond crisis going on, especially in the front end of the curve, and that was exacerbated by retail investors going to redeem their wealth management products, and if the bond yields continue to rise, that's not really good for funding environment in China, where China's trying to encourage banks to lend and companies to borrow.
OK, Lentin Tu, thank you for the analysis and the update on what's happening in China around the inflation dynamics and, of course, the tech story as well. John, I want to get your view then, of course, and let's bring it back to what's happening with the Federal Reserve. But before I get to the 60-40 question, so Mary Daly saying, look, a pause is not in the cards, but you seem to get to the point where, for some investors at least, a slowdown, the analysis is you get a slowdown in the rate hike cycle, and that very quickly is followed by a pause. Is that a miscalculation by some of these market participants?
I think there's a little bit of overexcitement, if we're honest about it, in terms of where the Fed are going. Look, let's look at the facts. I mean, the labour market is still, you know, creating jobs at a level which is well in excess of trend growth in the US. And we need to go through a period, if we are to avoid a full-on recession, where there's a period of sub-trend growth. And that means taking some of the steam out of the labour market. Clearly, we've had some good news on inflation, which the Fed will have watched closely. But these things take time to accrue. We're not going to suddenly, you know, come collapsing down back to the Fed's target in terms of inflation. It's going to be a gradual move over the course of next year. So will the Fed slow their pace? Well, yes, of course. I mean, you're not going to carry on hiking at 75 basis points a meeting, you know, ad infinitum. But does that translate to a pause and then a reversal? That's where I think the market is perhaps getting over its skis. Does it translate to a pause somewhere in the 5.25 kind of range? That seems sensible. But I think at that particular point, just remember, as inflation comes down next year, sometime during the first half, the front end of the curve will go from negative real rates to positive real rates. And that's going to mean that some of the restrictive financial conditions which have been hamstringing markets for much of this year are likely to persist. So it does feel as if markets perhaps are a little bit over-interpreting where the Fed go from here, where a pause is sensible, a pivot Probably not.
But that 5.25% call on the terminal rate from Goldman seems reasonable to you at this point?
Well, certainly where pricing's coming in. I mean, look, at the end of the day, with 4.75 through 5 through 5.25, 5.25 through 5.5, it translates to a similar kind of picture, which is, but for a little bit of rounding, a positive real interest rate at the front of the US curve at the beginning, during the first half of next year.
60-40. I still have it ringing in my ears, John, from last year. The number of strategists and analysts and fund managers we had was saying the 60 portfolio strategy, it's just dead in the water. You say it's now back. Is that a call on the end of the bond market route, or is that a call on equities? Well,
I think it's more than that, because, I mean, it's the usual Mark Twain thing, rumours of death being much exaggerated, certainly in the case of the 60-40. It's actually more a question of actually being able to look again at the longer term. We've gone through a period...
Is that a 2-year horizon, 5-year horizon?
This is a 10-year horizon. So we think that a US dollar 60-40 base portfolio, global stocks, US aggregate bonds, should be able to deliver around 7.2% expected return on average over the next 10 years. And at the moment, we've had a year where everybody's been in the bunker, looking at short-term moves, what the Fed doing, where's inflation going. And we would simply encourage and say, look, it's been a tough year. We know that. The 60-40 suffered a 19% drawdown from top to tail. The S&P 500 lost the equivalent in market cap of Germany, Japan and Canada put together. Okay? This has been a tough old year. But we would argue that as we look forward, as we look at longer-term projections, yields are now above their equilibrium level. Valuation excesses within the equity market have unwound. The underlying assets themselves are not fundamentally broken. This is not 2008, where the banks had gone bang, or 2012, where countries around Europe were in distress. This is a question of simply resetting some of the dislocations that had existed for a long time. So we would simply encourage folks to begin to look again at the long term. Yes, we've got a tough year ahead. Don't doubt that. A lot of volatility to come, a lot of uncertainty. But to begin to plan for the long term, we've finally got a place where the 60-40, the liquid asset markets, are beginning to allow us to achieve long-term portfolio objectives. OK, 7% annual returns, above 7% annual returns over a 10, 15-year period on 60-40 is the call from JP Morgan. John Bilton, thank you very much indeed for coming to the studio, head of Global Multi-Asset Strategy at, of course, JP Morgan Asset Management. Of course, we're speaking as well to Bloomberg's Lintian Tu, giving us the latest on China. Now, coming up, we're going to hear from Ukrainian President Volodymyr Zelensky, who spoke with Bloomberg's editor-in-chief John Micklethwaite from the new Economic Forum in Singapore. Do not miss that interview. This is Bloomberg.
We would really want to hear that the perpetrator country is a Russian Federation. We would be happy if the spade could be named spade.
China and the United States, as two major countries, both stand to gain from cooperation and lose from confrontation.
We're at the beginning of a bridge-building effort.
As we look at supply chains around the world, they were fit for 20 to 30 years ago.
The central banks misread the signs. They misread the risk of persistent and much higher inflation.
My team, for choice, thinks 2023, we avoid a recession. I'm a little more skeptical.
We're going to have new and improved data access protocols such that only an entity of U.S. residents that in the U.S. will have access to a certain set of U.S. protected data.
Crypto industry's been cut to ribbons this year. It's just too risky to sit out with a bunch of cowboys who have managed to blow themselves up.
OK, hearing there about the top risks that dominated talks among business and policy leaders at the new Economy Forum in Singapore. Now, the Ukrainian President Volodymyr Zelensky was also speaking there to Bloomberg on the final day of the new Economy Forum. He says the war with Russia will end only when Crimea and Donbass are returned to Ukraine.
Our war is the war for our lives. First, you do remember the scale of occupation by Russia of our territory and what happened since the 24th of February. And our objective was to stay strong and bring back the life and peace on our land. Unless we deoccupy our whole territory, this will not bring peace to us. Unfortunately, this is the leader of Russian Federation. This is his decision. We see this. They don't want Ukraine to develop. Ukraine has chosen its way forward, and it will develop. And it is developing. In some areas, we're developing faster, even during the war, than Russia Federation, which doesn't have war on its soil. And so for the stability of the situation for our country, we have to take certain steps. And I think that restoration of territorial integrity of our country is one of those important steps to be made, and also the support of international community investment, etc.
To be absolutely clear about it, deoccupying, as you put it, includes Crimea. It is an important difference, because it would be taking the border back to where it was, the effective border where it was in 2014. Is that your starting point before peace can happen?
Crimea is part of Ukraine. This is not just a state within a state. It's part of our country and part of our sovereignty. Therefore, indeed, the occupation of the Crimea and Donbass will bring the end to the war.
And that, of course, was Ukrainian President Volodymyr Zelensky in conversation with Bloomberg editor-in-chief John Micklethwaite on the final day of the Bloomberg New Economy Forum in Singapore. Now, the fallout from the rapid collapse of FTX is spreading across the crypto world, ensnaring the billionaire Winklevoss twins through a liquidity squeeze at their lending partner, Genesis. Joining me now is Bloomberg's Saveshri Ghosh. Saveshri, what are the contagion risks that are unravelling now? These Winklevoss twins, they were meant to be the grown-ups in the room when it came to the world of crypto.
Indeed, they were, and many more, so seriously. So FTX filed for bankruptcy, and it has been a week since then, and we are seeing the contagion risks continue to spill over around. From crypto exchanges to crypto brokerages. It was with Genesis. Genesis is a crypto brokerage which had to halt withdrawals, and after that, that spilled over to its lender, Gemini, which is, as you said, the Winklevoss's billionaire-owned company. So there you see that, there is an earned product. Gemini has an earned product, and $700 million worth of tokens are invested through this earned product on Genesis. And that's how the spillover risk has now, moved to Gemini, which is also seeing quite a bit of withdrawals from its overall exchange platform. So it's still an evolving story. We are seeing lots of, contagion risks spreading around. We don't know when the next shoe will drop, to be honest. But yes, it doesn't look like it's going to end soon.
And how are the crypto markets kind of repricing this volatility and this uncertainty?
Now, at least today, the crypto market has been pretty much stable. We are seeing the Bitcoin price around $17,000 level, which is pretty much a steady level. It looks like for some time at least, the crypto markets have priced in the volatility from the contagion. However, we never know, because there is the bankruptcy filing risks from several other companies that we already are hearing names like BlockFi and and Genesis. So there could be some kind of more volatility we can wait for in the crypto market as well. But for today, it was priced in.
Yeah, maybe a very brief, fleeting moment of calm across these crypto markets. Bloomberg's Saveshri Ghosh, thank you for giving us the latest on the fallout, of course, of the collapse of FTX. Now, coming up a little later, we're going to have our special coverage ahead of the UK's autumn statement. Do not miss that, and the analysis and the guests that we have to preview that important event, of course, from the UK Chancellor. Stay with us. This is Bloomberg. Welcome back. Let's get to the Bloomberg First Word News now with Laura Wright. Laura.
The People's Bank of China is warning inflation may accelerate as overall demand in the economy picks up. Analysts said the comments suggest the central bank could be shifting its focus away from adding more stimulus. Chinese regulators, meanwhile, are said to have asked commercial banks to report on their ability to meet short-term obligations. That's after a risk-on mood saw a rapid bond sell-off, triggering a flood of withdrawals from fixed-income products. Republicans have won control of the U.S. House of Representatives, but by a far slimmer margin than predicted. AP reports that the party now has the 218 seats for a majority after a win in a district of California. Despite concerns about Biden's handling of the economy, voters delivered a split verdict over who was to blame, with issues such as abortion rights and threats to democracy also in focus. This is Bloomberg. Tom.
All right, Laura, thank you. Coming up, we're going to have special coverage of the UK's autumn statement with a lineup of key guests and expert analysis. Stay with us. This is Bloomberg. Good morning and welcome to Bloomberg UK, a new show with a special focus on the biggest challenges facing the British government, economy, financial services and markets. I'm Tom Mackenzie in London. Now, when Chancellor Jeremy Hunt delivers the autumn statement later today, he has one big mission: restore the UK's credibility with financial markets. That, of course, after Liz Truss and Kwasi Kwarteng's disastrous mini-budget back in September. In the offing, a big package of spending cuts and tax rises. The challenge: curbing rampant inflation without pushing the economy into an even greater downturn than it already faces. To help navigate all of these topics for us, we've got a panel of experts. First, let's head out to Westminster to get the latest then from our UK correspondent Lizzie Burden, who's on the ground for us. Lizzie, give us the big picture. What can we expect from this all-important fiscal statement today? The drumbeat has been going on in the background for a number of weeks.
Well, Tom, we can expect austerity on steroids. We've been getting lots and lots of briefings about the content of this autumn statement. That's the classic Rishi Sunak playbook from when he was Chancellor, not to shock the markets. And the new Chancellor, Jeremy Hunt, says that there are eye-wateringly difficult decisions ahead today in terms of tax rises and spending cuts, because he needs to balance the books. Now, I spoke to the new Treasury Select Committee Chairwoman, Harriet Baldwin, earlier. Here she is explaining why that's necessary.
I think it's really important that the UK demonstrate today that we can pay our way, and after the guardrails, as you put them, sort of slightly fell away during September and October, that we are back on track and well guarded on all sides by the institutional strength of the United Kingdom.
But the Chancellor really is walking a very fine line between pleasing the markets and pleasing the voters. And the economic reality is, if he's going to tame inflation, he's going to have to weigh on demand.
Liz, we often get in these autumn statements the Chancellor pulling a proverbial rabbit out of the hat. Are we expecting any surprises this time around?
Well, Jeremy Hunt has said there won't be a rabbit coming out of the hat today, but there are a number of questions that we want answers to. What will be the balance between tax rises and spending cuts? Is he going to backload some of this austerity until after the 2024 general election, and how will that go down with markets? Is he going to overcompensate in plugging the fiscal gap? Who's going to be hit by these tax rises? Who's going to benefit from support? But it's classic Rishi Sunak to under-promise, over-deliver. You can perhaps expend some extra billions of pounds on, as I think it was Alex Wickham who reported, making homes more energy efficient to reduce energy demand. And also, Rishi Sunak has said that his top priority is inflation. He seems to be a bit confused whether it's inflation or controlling illegal immigration. But close behind those is education. So you can perhaps expect some more spending there.
OK, and we're going to be bringing in Alex Wickham very shortly for his analysis as well, Lizzie. Before we do that, one last question on the backloading of some of these measures then, and the thinking behind that. What is the rationale for pushing back some of these spending cuts, some of these tax rises?
Well, it's a naked attempt to win over the public because no one wants to return to austerity. Labour's already calling it austerity 2.0. But by saying that it is going to happen at some point, the Chancellor will be hoping that the markets will be convinced that this fiscal largesse isn't just going to be inflated away, as perhaps was the thinking with the mini-budget in September, hence the market turmoil then.
OK, Lizzie Burden on the ground for us, of course, outside the Houses of Parliament, leading up to that important statement, of course, the autumn statement. Let's bring in now Alex Wickham, our BN reporter, who, of course, is incredibly well-sourced and has been following all of these things for us for a very long time and is kind of very well briefed on what we can expect. Alex, we were talking in the break about the fact that there's been leak after leak in the build-up to this statement. How much of that is about putting some kind of boundaries around the expectations? There's going to be a lot of pain. This is about softening that public reaction for what is going to be a brutal autumn statement.
Absolutely. We've heard a lot in the papers over the last couple of weeks about things that Jeremy Hunt is considering and, you know, things that Treasury officials are supposedly looking at. Things like putting the top rate of income tax up to 50p, which would be, for a Tory government, a pretty extraordinary thing to do. And certainly speaking to Conservative MPs, they simply don't believe that that's a genuine thing that's under consideration. What they think that is a bit of a kite flown by the Treasury through the media to sort of say, well, look, it could be even worse. Look at what we could be doing. You know, I know you're not going to like what's in the autumn statement, but at least we didn't do X, Y, Z. However, the reality is that whatever comes out today, rises in council tax, things like that, those are very tough politically for Conservatives to be putting on the public and their own voters. OK, Alex is staying with us for more on the political angle for this as well. But let's bring in now Gemma Tetlow, who's Chief Economist at the Institute for Government. And, of course, we'll continue to get back to Alex for the political lines on this story. Gemma, thank you for joining us this morning. What is your analysis of the impact on the economy and growth as we look into 2023? We don't have the autumn statement yet, but a lot has been flagged. What is your forecast at this point?
I mean, as you've already been discussing, the government faces a very tricky balancing act here to show credibility on the public finances, get borrowing and debt under control, whilst not unnecessarily aggravating the recession that's coming. But we are in a situation where the Bank of England thinks that we need an economic slowdown to get inflation under control. So actually, it's quite likely that a lot of any fiscal action would be offset by monetary policy. So if the government goes for a looser stance on fiscal policy, then that could result in somewhat higher interest rates than otherwise would be the case, and vice versa. If the government goes tight on fiscal policy, there is some scope for the Bank of England to offset that. So there are lots of dynamics going on here. And obviously one important factor for households is energy prices over the next year or so. And so I think probably the focus of government support in the near term will be what do they do for energy bills beyond April. We know the energy price guarantee is currently set out, ends at the end of March. So what does Hunt do to support households with those short-term costs of living, whilst at the same time getting public finances back on a sort of sustainable path?
So, and that ties in, of course, we saw the CPI print yesterday, 11.1% coming well above the forecasts, Gemma. On the question of energy, how much scope does the government have to expand that cap beyond April? If it becomes more targeted, do we have a sense of what the drag will be then on inflation in the quarters beyond April?
Obviously, the energy price guarantee, by sort of bringing down near-term energy costs, in a sense, slightly extends the period over which we see higher inflation, because it takes longer for that to drop out, rather than having a big short-term spike and then dropping back. We see a bit more of a prolonged period of somewhat higher inflation. The possible danger of that is that people start to build it into their expectations more, that the longer a high inflation goes on, the more they expect that to continue. However, from sort of what could they do fiscally, I think it would be interesting to see.
Sounds like we may have a technical problem with Gemma. Gemma, we'll just try and check your line, because you just dropped out there for a second, so our technical team will check in on that. I want to bring back in Alex Wickham then for the politics of this. And Alex, you've been, there is a sense, and Lizzie was saying, that describing it as kind of naked politicking around the backloading of some of these measures post, of course, the election. It has to be held by January 2025 at the latest. how confident is the Conservative Party that they can close this polling gap with Labour, given that they seem to be looking at some of the policy measures that the Labour government, opposition Labour Party, I should say, have touted themselves, whether it's a windfall tax on energy or more support for lower income households?
I think the answer is not very confident. You know, the dual challenge of this autumn statement is that, yes, they've got to calm the markets, but they've also got to give something to voters to make them think that there's a point in voting Conservative at the next election. If all they're getting is sort of managed decline, you know, after 12 years of Tory government, this is the best we can do, this is where we're leaving the country heading into the next election, that is a very tough sell to the public. And these are tax rises across the board with spending cuts. And, you know, whether they're felt in time for the election or not, that is the mood music that we'll have going into it. And, you know, certainly speaking to Tory MPs and advisors over the last couple of weeks, they are very glum about the prospects of any sort of positive message or strategy for the public. How do you sell this to the public in any other way other than we messed up and it's going to be painful?
And no doubt they'll be watching the polls very quickly or very closely after this autumn statement. They currently have a deficit, about 20 points in the polls versus the opposition Labour Party. Very pleased to say we're now joined by Andrew Sentance, Senior Advisor to Cambridge Econometrics and, of course, importantly, former member of the Bank of England's Monetary Policy Committee. Good morning, Andrew. Thanks for coming into the studio.
Yep.
What is your level of confidence that the UK Chancellor can both reassure the markets and avoid a complete collapse of UK public services?
Well, as you're indicating, he's got quite a difficult balancing act to do. He obviously has to show that the government has a grip on public finances, that they have an idea of where the economy is going, which is realistic, which will probably need to factor in some form of recession over the next 12 to 18 months. But at the same time, they've got to also make sure that the public spending and tax numbers add up. I think all the rhetoric from the Liz Truss camp about tax cuts is really off the agenda. The question is how much tax raising do we need to balance the books? And as your question suggests, that you can't just continually squeeze public spending. That was not very successful after the global financial crisis. So there needs to be some restraint of public spending, which will need to be quite targeted so that it doesn't fall on areas that are very sensitive, like health and education, which are also important for the running of the economy. But going too far in terms of squeezing public spending and cutting back on public investment would not be good for the economy.
And we saw that print, the inflation print yesterday, 11.1%. The Prime Minister says it's his #1 target to tackle inflation. And we know that BOE and Andrew Bailey, of course, very closely focused on this as well. Is it your assessment that inflation, though eye-wateringly high yesterday, is now peaking in the UK?
Well, it's close to the peak that the Bank of England indicated. They suggested an average of 10.9% over the 3 months, October to December. And perhaps a little bit higher. But I think the main thing about inflation is it's going to not be until the middle of next year when it really starts to come down significantly. So it's going to be over 10% until the middle of next year, according to the bank's forecast. You say that the bank is focused on controlling inflation, but they haven't done a very good job so far. And they were very slow at raising interest rates last year. And I think they've been overcautious in terms of getting a grip on inflation. It's not primarily Jeremy Hunt's job to get on top of inflation. That's the job of the Bank of England. What he needs to do is provide a stable backdrop so the bank can do its job. So we don't want big lurches in public spending or taxation in one direction or the other in the short term.
OK, and I want to get back to your views on the need for additional rate hikes and how the BOE is behind the curve on this. But I want to bring back in Gemma at this point, Gemma Tetlow from the Institute for Government. Gemma, you touched on this when we spoke a couple of minutes ago. Are you on the labour market and the strength of the labour market here in the UK and what that challenge that poses to the inflation dynamics? Are you starting to see evidence, is that coming through in the data, of a wage price spiral?
One of the problems that's definitely facing the UK is tightness in the labour market, and that's largely because we've seen a lot of people dropping out of the labour market after the pandemic, and some of that seems to be poor health related. So a lot of these challenges are interrelated, and for example, backlogs in the health service are probably not helping people to get healthy again and get back to work, and that is causing more pressure on inflation because of the tight labour market. It's difficult to say there's really any evidence of wage price spirals. I think we are in a very different world from sort of 1970s when we last had an oil price shock, because there's very low rates of unionisation and much less widespread collective bargaining on wages, which makes it less likely we're going to see a wage price spiral emerging.
Andrew, let's bring it back to rate hikes then, with that backdrop around the tightness of the labour market. 4.5% seems to be what the markets, certainly Bloomberg Economics, are looking at 4.5% as the terminal rate for the BOE. Is that enough to get inflation back down to target?
Well, I'm not sure it will be enough. You're quite right to say that many people are looking at somewhere between 4 and 5%, where interest rates will go in the short term. But the question is then, if they get there, say, within the next 3 to 6 months, is that going to be sufficient to bring down inflation? And with the latest numbers showing inflation over 11%, and RPI inflation is 14.2%. These are eye-watering figures, and it does suggest to me that interest rates will need to go possibly above 5%, perhaps into the 6 to 7% range, by the middle of next year, in order to get a grip on inflation.
6 to 7%. Next year.
That's quite possible. Yes, I'm not saying that's nailed on. No. But that's the sort of range that people need to think is quite possible.
What kind of depth of recession does 6 to 7% translate to then?
Well, I think that depends a lot on what's going on other fronts, like the state of the world economy, what's happening with energy prices, etc. But it's certainly not going to be helpful to the real economy, and it's going to be a big shock for many households and firms. Now, I'm not saying that's my central forecast, but that's the risk forecast. Right. That if we can't get on top of inflation, that's where the Bank of England may need to go.
OK, Andrew Sentance, thank you very much for your time, for joining us in the studio ahead of this autumn statement. Of course, former member of the MPC, now senior advisor to Cambridge Econometrics. And of course, we thank Gemma Tetlow, chief economist at the Institute for Government, and Bloomberg's very own Alex Wickham as well, with a string of scoops leading up to this autumn statement. Now, coming up, more on UK personal finance ahead of the Chancellor's autumn budget statement. Stay with us for that. This is Bloomberg.
It sounds like we are having a big tax rise, but it's going to come from perhaps lots and lots and lots of smaller measures. So freezing many tax allowances, so the point at which people start to pay income tax, the point at which people start to pay higher rate tax, freezing, for example, limits on pension contributions, freezing the point at which people start to pay inheritance tax, some explicit tax rises too, possibly cutting the annual allowance for capital gains tax.
That was IFS Deputy Director Carl Emerson on his expectations for today's autumn statement. And if audio is your cup of tea, don't forget our UK and London-focused podcast, In the City. Episodes are out every Thursday on your favourite podcasting service. Now, coming up, John Stepek, author of Bloomberg's new Money Distilled newsletter, joins us for more on the autumn statement, what it means for your UK personal finances. Stay with us for that. This is Bloomberg. Welcome back to Bloomberg UK. I'm Tom Mackenzie here in London. Now, UK Chancellor Jeremy Hunt delivers, of course, his autumn budget statement today as he wrestles with inflation at 11.1% in the year to October. That is the highest in more than 4 decades, 41 years. Joining us now, I am pleased to welcome Bloomberg's John Stepek, who looks at all things personal finance and the implications of the macroeconomics and monetary policy on personal finance. John, what can we expect then? What are you looking at from the autumn statement, from your perspective?
I mean, the main thing from my perspective is fiscal drag. There's a great quote from the chap who was Louis XIV's finance minister.
Wow, we're going all the way back to Louis XIV.
All the way back, Jean-Baptiste Colbert.
Yeah.
And he basically said the art of taxation consists in so plucking the goose as to obtain the largest possible amount of feathers with the smallest possible amount of hissing. And basically, we're the goose and Hunt is the feather plucker, and there's an awful lot of plucking to be done, unfortunately. I mean, fiscal drag is what happens when you freeze tax thresholds. And all that happens then is that more and more people end up paying the tax as a result of inflation rather than because their real wealth has gone up.
This is the stealth tax.
Yeah, it's the stealth tax. And I mean, it's sneaky, but it does work because it doesn't tend to hit people immediately. Its effects only become apparent over time. But at the same time, it raises a lot of money. I mean, there's one good example. So the 45% tax rate, additional tax rate, top rate income tax in the UK, over the past 10 years, the threshold for that hasn't changed. So you pay it once you earn above £150,000 a year. Now, in 2013-2014 tax year, 311,000 people paid that. That is projected for the 2022-23 tax year to be 629,000 people. So it's doubled over the course of a decade, and that's purely because the threshold hasn't changed. You know, if the threshold had gone up with inflation, then the number of taxpayers paying it would also not have risen as rapidly as that. And there's similar impacts further down the scale from things like child benefit. So once someone in your household earns above £50,000, if you get kids, you know, you get child benefit. It used to be a universal benefit. Now it's gradually withdrawn as soon as someone in the household earns above £50,000. Now again, that threshold hasn't changed since it was introduced. And the number of taxpayers that it captures has gone up from about 750,000 to nearly 1 million households now. So basically it makes us poorer over time, but we don't notice it as much because...
It's good news for the Treasury.
It's good, and it's great news for the Treasury.
John, give us the strategies, give us the tips for avoiding this upcoming storm that's about to be unleashed, or is already being unleashed on households around the UK. What can we do?
Well, no, this is the tricky thing. I hate to say it, but you really, what you really need to do is be on top of your personal finances in a way that I think that we've perhaps got out of the habit of over the last 10 years or so. So in the last 10 years, for example, you know, we haven't had to worry about inflation. We haven't had to worry particularly about savings rates because there haven't been any. You know, so for example, if you've had cash in your savings account, you've got used to it paying 0% and not really thinking about it. Now you can probably get about 4.5% if you shop around. So even though you're still getting hammered in real terms after inflation, at least it's not as bad as it could be.
John, we have to leave it there, but another tip would be to read your newsletter, which is, of course, on the terminal and on Bloomberg.com. Thank you, John Stepek, there for joining us. Now, check out Bloomberg's, I've done it already, UK New Vertical. That is on Bloomberg UK Wealth. It focuses on personal finance, aiming to help people make smarter decisions about their money. Never more important. Head to Bloomberg.com/UK Wealth, where you can discover new features, including John Stepek's free daily newsletter, Money Distilled. Bloomberg Surveillance Early Edition is in the next hour. Stay with us. This is Bloomberg.
What central banks around the world have clearly recognized is that they need to move in a determined fashion to durably bring inflation down.
I think that the main risk now for financial stability is that we are going to see lower growth.
And the price of energy and not the purity of energy becomes number one for many countries. And this wouldn't have been the case had it not been for Russian aggression.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York and 6 p.m. in Hong Kong. Our top stories today. Budget day in the UK. Jeremy Hunt will try to reassure markets he can stabilise public finances without devastating cuts in government services. The crypto crisis spreads. The fallout from the collapse of FTX has now ensnared the billionaire Winklevoss twins. And a power shift on Capitol Hill. Republicans narrowly regain control of the House, giving them the ability to block President Biden's agenda. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. We reflect on the market moves of yesterday, Kailey, and concerns once again about the Fed and the extent of tightening we're going to see. And markets pretty muted this morning with that in mind. Of course, the focus here on the autumn statement.
Yeah, we're waiting for that to come up in just about an hour and a half's time, Anna. So definitely markets in the UK and really around the world will be paying attention to that. But as you say, muted sentiment overall, and it was definitely in the more downward direction in the Asian session overnight. Stocks there broadly lower. The MSCI Asia Pacific Index down by about 0.8%. One of the biggest drags within Asian equities was Chinese technology stocks. The Hang Seng Tech Index down about 2.2%. Now, part of that had to do with Meituan shares dropping after Tencent's announcement yesterday that it's going to offload about $20 billion of those shares. So that dragged overall. But Chinese equities more broadly were hurt by a PBOC statement about inflation, saying it could pick back up as demand in the economy revives itself. So that indicates that the scope for monetary policy easing may be limited. And of course, you also have seen a lot of movement in the short end of the government bond curve in China. The two-year yield now at 2.16, which is the highest since August. And you actually had Chinese regulators asking banks about their ability to meet obligations given the bond sell-off we have seen. So that is a story to watch. Finally, in foreign exchange, I would note that the offshore yuan is one of the big underperformers against the U.S. dollar, though basically all currencies in Asia and G10 are weaker against the dollar today, but the yuan being one of them, weakening by about 0.6%. We're at the 715 level at the moment, Matt.
All right, take a look at what's going on in S&P futures. We are down after the finish down yesterday in the cash trade. I think we were around 3,952 on the S&P, and it looks like we could come further away from that 4,000 level as markets are dissuaded by Fed speakers about counting on a pause, if not a pivot. The Bloomberg Dollar Index also a headwind, rising up again today to 1278. The U.S. 10-year yield also a headwind, rising up today to 372. Although it should be said that we've been seeing 380s over the last few sessions, and it's much better than the 4 and change that we had seen before last week. So even though yields are rising on the 10-year, they're still really low compared to what we've seen over the past weeks and months. Bitcoin right now is down about 0.1%, still hovering around the same level that it was yesterday and the day before. What's today, Wednesday? No, today's Thursday. And the day before, Bitcoin has just been hanging around 16,000 and change ever since the dramatic collapse of FTX. And it doesn't seem to be any more or less volatile than the S&P, which has also been hovering around the same levels all week. Anna, what do you see in Europe?
Yeah, well, it's definitely Thursday here in Europe, Matt, I can confirm. Don't do that to us. Don't make us do it all again. We've got the London market underperforming. Basic resources under pressure today, in keeping with a slight slip in that global risk appetite, and that's weighing on those global resource stocks. So we're down by 0.5% in London, down by 0.5% on the CAC 40, also in Paris. The German market really stands out, though, up by 0.25%, and it is one of the heavyweight German names that is taking us there. We'll come to that. In fact, let's go to that now then. Siemens is up by 6.6% today, and this is having a big upward impact on that German market. The engineering giant reporting numbers, and it seems that it's the factory automation side of things that's really delighted the investor community, and certainly I've seen some very positive broker comment, analyst comment as a result of that. Burberry, I also put this one in here, not for the share price move, as you can see it's not moving very much, but an interesting story. They reported numbers earlier on. There's been a changing of the guard at Burberry recently, and they talked about bringing back the Britishness. Now, I don't know what that means, but I'm sure they do, so that'll be interesting to watch. The euro is down by 0.3%, 103.65, so just backing away from that 104 handle. Interesting reporting by our Bloomberg colleagues tracking the ECB story, saying that perhaps we'll see a downshift from the ECB from 75 to 50. I spoke to Plurimi Wealth Management earlier on, and they were saying that would be their view because they don't think that the ECB or the Bank of England will want to do more than the Fed. And so if the Fed downshifts, we can expect the same elsewhere, is what they were saying. Talking of the Bank of England, they'll be closely watching the pound, they'll be watching gilt markets, and they'll be closely keeping their eye on what what's going on in Westminster with the UK Chancellor Jeremy Hunt set to deliver his autumn statement. So with all of that in mind, I put a focus on UK assets. We will focus later today on the House of Commons. Jeremy Hunt will be attempting to reassure markets he can stabilise UK public finances without inflicting devastating damage on public services. Bloomberg's Lizzie Burden joins us now from Westminster. Lizzie, give us the big picture then. What can we expect to see in this fiscal statement today?
And what we can expect is austerity on steroids. Most of this statement seems to have already been briefed. That's classic Rishi Sunak from when he was Chancellor. And the new Chancellor, Jeremy Hunt, has said that we're expecting eye-wateringly difficult decisions in terms of spending cuts and tax rises. Apologies, there's the same old protester that we see every week in Westminster behind me. But the reason that Jeremy Hunt is having to make these decisions is, it is, Steve, indeed, this gaping hole in the public finances. And I was speaking to the Treasury Select Committee Chairwoman Harriet Baldwin earlier. Here she is explaining why that's so important.
It's really important that the UK demonstrate today that we can pay our way, and after the guardrails, as you put them, sort of slightly fell away during September and October, that we are back on track and well guarded on all sides by the institutional strength of the United Kingdom.
But Jeremy Hunt is facing into the storm, as we have been briefed. He has to tame inflation, but that will require weighing on demand. So it's a very, very fine line between pleasing the markets and pleasing the voters.
Yeah, I don't envy Mr. Hunt. It's going to be very difficult. Where could we see some surprises, Lizzie?
Well, there are lots of questions that we're waiting for the answers to. What will be the balance between tax rises and spending cuts? How much of this fiscal squeeze will be backloaded until after the 2024 general election? Who's going to bear the brunt of these tax rises? Who actually has the broadest shoulders in the government's mind? And is the Chancellor going to overcompensate in terms of plugging this fiscal gap? That will all be very closely watched by the markets, but really we also need to see, are they over-relying on this closeness now renewed between the Treasury and the UK's economic institutions? Are they taking liberties with the dullness dividend?
All right, Lizzie, thanks very much. Bloomberg's Lizzie Burden there reporting on the autumn, what do you call it? The autumn statement?
Correct.
The autumn statement coming
Nailed
out.
it.
All of a sudden, we all know what this is after, well, Liz Truss did one great thing for the UK. All right, Ukraine's president, Volodymyr Zelensky, has laid out his conditions for peace. Zelensky says a ceasefire won't be enough, and only the return of territory taken by Russia will allow an end to the war. Speaking at the Bloomberg New Economy Forum in Singapore, Zelensky also weighed in on the missile that struck Poland earlier this week.
I don't know what happened this time. We don't know 100%. I think the world also doesn't know what happened 100% in that situation. But I'm sure that this is a Russian missile, and I'm sure that we were launching the air defense missiles, but we can't say specifically that this was the air defense of Ukraine, although we are grateful for not being blamed because we are fighting against Russian missiles on our territory. But nevertheless, we have to be fair and honest. Until the investigation is over, we can't say what kind of missile or what pieces of which missile fell on the Polish territory.
Let's get to Bloomberg's Anne-Marie Hordern. She remains in Bali after the G20 meetings there. So, Anne-Marie, what else did we hear from Zelensky in this speech and the interview that followed?
Well, he's really just rejecting these claims by the U.S., Poland, NATO, that for sure what it looks like in terms of the evidence that this was a Ukrainian defense system that was shooting down a barrage of Russian missiles that ended up in Poland. And what Zelensky says is he wants Kyiv to be a part of the investigation. He also wants to send Ukrainian officials to Poland. But the president, when he landed back at the White House overnight, very late last night, he said that's not the evidence. So the U.S. is looking at the evidence evidence. Several U.S. officials said this is what it does seem to be. They obviously call this an unfortunate situation. You've heard that throughout the past 24 hours. But it's kind of an intense, tense, awkward moment because you have Zelensky really pitting himself in terms of what happened in Poland against his main allies. And that is, of course, the U.S. and all of NATO.
Back in Washington, where you spend most of your time, Anne-Marie, we have, of course, a changing of the guard in a sense in the House, the GOP retaking the US House by a slim margin in a power shift in Washington that stops short of the Senate, of course. What difference does this make?
Yeah, they got that magic number 218 yesterday, and a Republican was able to maintain his seat in California. It is not the red wave that the Republicans were predicting, but still, a majority is a majority, and that means they have control of these councils that will be able to subpoena either individuals from the Biden administration or also his family, individuals from the Biden family, including potentially his son, Hunter Biden. This has been something the Republicans have been talking about. So that is what you can expect. When it comes to the markets, what everyone really will probably start to focus on is the fact that we have the debt ceiling issue, and the Republicans may use this opportunity to use that hostage to force the president to enact spending cuts. But the president on Air Force One, on his way home from Bali, where I do still remain, this is what he had to say when the Republicans clinched the House. He said, "I congratulate Leader McCarthy on Republicans winning the House majority and am ready to work with House Republicans and deliver results for working families." So the president says he will work with anyone when it comes to tackling big issues. Another important moment. This, of course, means that Speaker Pelosi will no longer be Speaker, and she says, her office says, she has an announcement today about her future plans. So stay tuned for that.
All right, Bloomberg's Anne-Marie Horder still reporting from Bali. Thank you so much for joining us. Let's turn now to the world of crypto. Former FTX CEO Sam Bankman-Fried is telling his side of the company's collapse, and he's doing it through a series of tweets. SBF admitted that FTX got overconfident and careless and said he would do his best to save customers' cash. And Matt, just to give a little color on what he said exactly happened, he essentially said the crash came in a few-day period, a historic crash, almost 50% in most correlated assets, with no bid-side liquidity at the same time that there was a run on the bank. So in summary, $13 billion of leverage, total run on the bank, total collapse in asset value all at once, which is why you don't want that leverage. So basically just kind of a worst nightmare scenario, and we continue to see the dominoes falling in the crypto world.
Yeah.
BlockFi, Genesis, Gemini.
Yeah, and I think it's really interesting that you see Gemini and Genesis getting hit as well. So these are more people that we thought were very serious players. I'm not saying they aren't, but they definitely were willing to take exposure to Sam Bankman-Fried just through his fame alone, as he said he was on the cover of every magazine. The thing I find really fascinating is that it seems as if SBF is still under the impression that Serum, Solana, and FTT that he holds on his balance sheet, or that FTX or Alameda hold on their balance sheet, is worth $3.3 billion. Like, he doesn't understand that the value of that stuff has just dumped.
Yeah, absolutely. Interesting stuff. And then to think about where we go from here, what role does Binance play? And I know we talked in the past about what role there is for consolidation in this sector, what need there is in a world that likes to remain decentralized. What happens when you centralize so much of it under one person, under CZ? And we now see Binance is preparing a bid for Voyager Digital, at least according to CoinDesk. Kailey.
All right, Anna, so definitely continuing to keep in mind all the twists and turns of that saga. But let's now take a look back at the equity market and some stocks moving in pre-market trading here in the U.S., because there's a trio of them moving to the upside after earnings. The first being Cisco, which topped estimates and gave a bullish revenue forecast, signals that there is still technology spending going on among corporate customers. That stock up about 4%. You also have NVIDIA higher after its results. Yes, there is softness in the PC chip market, but AI and data center business really giving a lift to the company's revenue. So they also topped expectations, and that stock is higher by about 2.3%. And one final stock to mention, Grab. This is the Southeast Asian ride-hailing company. It reported a smaller, narrower loss than expected. Cost cuts finally kicking in and helping with that bottom line. So that stock up about 2.5% before the bell, Anna.
Coming up on the programme, we'll focus in on what to expect from the autumn statement today, a budget by any other name, basically. Hare joins us, HSBC Senior Economist. We'll get his perspective on what the UK does from here. How big is the hole in the fiscal story here in the UK that needs to be filled by the Chancellor today? And what role will fiscal drag play in filling it? We'll get to that shortly. This is Bloomberg.
Welcome back to Bloomberg Surveillance, the early edition. I'm Matt Miller, Kailey Leinz here in New York, Anna Edwards with us out of London. And the focus is firmly back on the UK today. We're all looking forward to Jeremy Hunt's autumn statement. I have a chart of debt to GDP, and it's interesting to see that the UK is actually doing really well compared to the US. We're looking at just about 99% debt to GDP for the UK in white. In blue, the US is showing 129% debt to GDP. Of course, we have, the world reserve currency here, but the UK is actually the second lowest debt to GDP in the entire G7. So as far as rich nations fare, it's doing quite well. Plus, its duration is much further out, right? It's not just about how much you owe, but how long do you have to pay? But nonetheless, it's still important to pay attention. Noor Al-Ali joins us from Bloomberg Markets Live. Noor, should we be freaked out about this, or is Jeremy Hunt, going to do okay today?
Morning, Matt. Well, look, you're absolutely right. If you look at credit default, the credit risk gauge for the UK, which is the 5-year CDS, you'll see that it's come down from the highs. You're seeing that markets are comparably a lot less panicked, or, they're much calmer coming into this budget session compared to, well, the recent episode that we've seen in recent months. So, from what I'm seeing, there's a lot more calm, but the prospects for the UK economy in the short term and into the next year, now that is concerning.
Yeah, that's interesting, the prospects for the economy. And Noor, in terms of what we look for today, I've had mixed views when I ask people how much the profiling matters, how much it matters if the pain is front-loaded or back-loaded. And some people say the market's attention is really on this, and other people say, no, I don't think it's going to matter too much. I think the UK is gaining back the market's trust and it'll be all right. What's your perspective of what matters today?
My perspective is on the ground, Anna. It's incredibly important to strike that balance today for Hunt. He's going to talk about a storm that the UK is headed into today. You're seeing the cost of living crisis, come in with the energy crisis, which, appears a lot less of a crisis at the moment for this winter. But what about next winter? And also you have that economic slowdown and those fears. The BOE, steadfast on raising rates right now, industrial output coming down lower.
Yeah.
It's a really bad picture right now in the UK.
Well, on the subject of the BOE, Noor, in theory, if you have more tightening on the fiscal side, that means monetary policy has to do less, no? So what are the BOE pricing implications here?
Well, the BOE appears to be set on the plan that it has put out some time ago. They are the first, developed central bank to actively sell their holdings. That's QT, starting out. They are raising rates, and perhaps not as aggressively as we've seen from the Fed. And inflation has not been reacting in the way that it had reacted in the U.S. It came in at 11.1% yesterday. It's, again, a fresh record of, 40-year high or so. And it would have come in at 13.8% had it not been for the support that we've seen on the energy front. So, we've had, for instance, Hugh Pill and Catherine Mann come and discuss the forward view. They're saying perhaps some pivot or some easing towards next year or the year after. But to be honest, right now, if you're looking at the market, you're looking at the pound, approaching 120. It has come off that right now because the dollar is stronger. But I'm not seeing a lot of, positives there for the pound.
Okay. Noor, thanks very much, Noor Al-Ali of the Bloomberg Markets Live team. And the team will be providing lots of coverage, of course, of the autumn statement. We'll bring that highlights to you here on Bloomberg TV. It'll be across the terminal. For more market analysis, check out MLIV Go. That is the function to use on the Bloomberg terminal to find the Markets Live blog. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Matt Miller in New York and Anna Edwards in London. Now keeping you up to date with news from around the world, here's the first word. In Europe, auto sales rose in October for the third month in a row. Still, there's concern that deteriorating economic conditions are starting to put off buyers. New car registrations climbed 14% last month. Europe's energy crisis is driving up costs and standing in the way of a more substantial recovery. The former chairman of Twitter says Elon Musk could be creating room for competitors. Patrick Pichette says that could happen if Musk breaks the ethos of the company. He told Radio Canada it's too early to tell if Musk will be good for Twitter. In the Senate, legislation protecting the right of same-sex couples to marry advanced with Republican support. That sets it up for passage by a simple majority vote as soon as this week. Democrats say the bill is necessary because of the chance a conservative Supreme Court could overturn the ruling that legalized same-sex marriages. And there was a surprising public confrontation at the G20 summit in Indonesia. China's President Xi Jinping accused Canada's Prime Minister Justin Trudeau of leaking details of a private meeting between the two. Xi told Trudeau the leak was inappropriate. Trudeau responded that Canadians believe in free, open, and frank dialogue. So as we continue to monitor geopolitics, we're also focused on domestic politics and the fiscal equation in the UK with the autumn statement due in just about an hour. We'll discuss with Chris Hare of HSBC. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Budget day in the UK. Jeremy Hunt will try to reassure markets he can stabilise public finances without devastating cuts in government services. The crypto crisis spreads. The fallout from the collapse of FTX has now ensnared the billionaire Winklevoss twins. And a power shift on Capitol Hill. Republicans narrowly regained control of the House, giving them the ability to block President Biden's agenda. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. And Matt, European equity markets a little bit weaker in the early part of the trading session, waiting for the set-piece event that is the autumn statement here in the UK, basically a budget. And looking at US futures, it seems everyone's gone off to make a cup of tea, get a coffee before the budget starts, because there's not really much happening there.
Yeah, I mean, what a better way to spend a Thursday morning than a nice warm cup of Builder's what is it called? Builder's tea, PG tips, and listen to Jeremy Hunt give his autumn statement. Look at the leaves changing color and watch while S&P futures recover a little bit. We're not really much changed, as you can see here, down about 0.06%. We did end the cash trade lower yesterday at 39.52, so moving incrementally further away from that 4,000 level that we eclipsed and then fell back below. The reason is we have headwinds in terms of dollar strength and 10-year yields. Both are increasing right now. You can see the Bloomberg U.S. dollar index at 1278 and the 10-year yield at 373.79 right now. Concern about Fed speakers who've come out and said, don't count on a pause, quit betting on a pivot. It's not going to happen. So as a result, the markets are less ebullient. Bitcoin right now down also very little, 0.05%, 16,522. So hovering on the same levels that we've seen all week long. Kailey, do you see any pre-market movers?
I do see some, and they're all related to earnings because we still are getting those trickling out, even though the season is pretty much almost entirely over. Cisco being one that reported after the bell yesterday. It beat in the quarter they reported, also gave a bullish forecast. Still seeing that technology spending in the corporate sector, so as a result, that stock up about 4%, while NVIDIA is up 2.4% after also beating expectations. It's the AI and data center chip business that's helping offset some weakness elsewhere. And Grab, the Southeast Asian ride-hailing company, had a narrower loss than expected. Cost cuts seem to finally be kicking in, so that stock up about 2.5%. Finally, Macy's. This one is reporting in just a couple hours before the opening bell here in the U.S. this morning. Of course, we've gotten a mixed bag for the retailers we've seen so far this week, but Macy's is going to be the first real tell on the apparel sector in particular. Ahead of its results, interestingly, Anna, that stock up about 2.5% before the bell.
Yeah, a lot of focus on US retailers this week then, Kailey. Let's have a look at where we are in Europe. Matt was saying not very ebullient in the futures picture for the US. Well, that's certainly the case here in Europe. European stocks down by 0.2%. Mining stocks taking the brunt of that in London, weighing on London. Siemens helps Germany to outperform, though. The engineering giant up by 7%. They reported numbers, and it seems that it's the factory automation side of the business that is structurally doing pretty well right now, at least according to analysts. Here we have the euro and the pound, and both of those are losing a little bit of ground against the US dollar. Maybe that slight tick up in the US dollar once again is something that takes the edge off risk assets, and certainly peak dollar conversations. We've had plenty of those over recent weeks. Interesting to see how far the pound has recovered, though, since that mini budget, so-called mini budget, which had anything but a mini effect on the markets. We went down to 103, which is more where the euro is currently trading, incidentally. But 118 is where we jumped back up to. But we are now waiting for Jeremy Hunt, the Chancellor, to speak, and he will do that we understand, in the next hour or so. We should hear from the Chancellor. Right now, we have Prime Minister Rishi Sunak speaking in the House of Commons, or at least he's getting ready to. He's going to be delivering some remarks. There he is, on his return from the G20 in Bali, giving his thoughts. He, of course, had a meeting with President Biden, and he was quite outspoken in his criticism of China then, Kailey.
Yep, but Anna, of course, really what we're watching for in the House of Commons is an hour from now, as you said, when we receive the autumn statement from Jeremy Hunt. That has major implications for the trajectory of growth and inflation in the UK economy. Joining us now to discuss it is Chris Hare. He is HSBC's Senior Economist. Chris, obviously this is a very hard line to walk, where you don't want to do too much restrictive in order to tank growth, but also they need to get spending under control. What is your expectation of what the balance struck will be today?
Yes, it's a really tough task for Chancellor Jeremy Hunt. I think we're looking out for a couple of things. The first is the size of this so-called fiscal black hole that a lot of people have been banding around, figures up to around 60 billion pounds or so. And of course, then how to fill it, what kind of mix we're going to see in terms of tax rises and spending cuts. But I think most interesting for me is the timing by which this fiscal belt tightening will happen. So from our perspective, we think that there's at least a chunk of backloading that's going to happen in terms of this belt tightening, i.e. certain tax rises and spending cuts that we extended out to 2025 or 2026 or so, such that the pain in terms of the macroeconomic headwinds will at least be smoothed out somewhat. But again, that raises a credibility question. If you're backloading your fiscal tightening by so much, then there are questions about, well, will it actually happen eventually?
Yes, especially, good morning to you, Chris, especially as 2025 takes us into a new parliament. That's after the next election. I mean, things as they stand right now, that would be everybody's assumption. So in terms of the Bank of England's calculations, I suppose things that are promised in 2025 might not have much impact. And in terms of the market's thinking, do those promises about 2025 have much impact?
Well, I think at least to some extent, because perceptions about fiscal credibility is not just necessarily about concrete action. Of course, concrete action is important, and we saw that with the unwinding of Trustonomics, which allowed markets to settle. But while we want to see some concrete action over the next 2-3 years or so, it's also about sort of vibes and direction of travel. And if the direction of travel is in the right sort of direction from a market's perspective, and it's one that talks about meeting fiscal targets, even though it's some way off, well, at least markets can think, well, the direction of travel is sort of okay. And when we come to the other side of a general election, it might be quite hard for a future government to really row back on that in a major way. So it has some impact, but we're certainly not looking like massive market panics as a result of this, we don't think.
Okay, yes. Well, let's everyone keeps their fingers crossed, I suppose, unless you're betting on that kind of thing. Let me ask you about fiscal drag, because that seems to be something we're really watching for today. There have been lots of promises in the 2019 manifesto by this government, under previous leadership, of course, that they wouldn't put up various taxes. So that limits the range of movement. They can't put up tax rates, but they can allow more and more people to be caught by taxes.
Yes, that's right. So by freezing income tax thresholds, the think tank, the Institute for Fiscal Studies, said that that could raise up to around £30 billion per year by 2026. So potentially it could be a pretty big revenue raiser, or a very big revenue raiser. But there are a couple of caveats associated with that. First, that's 2026. That's the other side of the next general election. And second, there's a question about, notwithstanding an election, it's still politically difficult to see such big rises in effective tax rates for so many people. So we are looking for other things in terms of potential consolidation. That could come in the form of spending cuts, which could be pretty hefty as we see the announcement in an hour's time.
How bad is the UK going to fare in terms of the upcoming recession compared to, say, continental European countries or the US?
Yeah, well, it's pretty tough times ahead for the UK. Unlike in the US, of course, Europe, including the UK, is facing high inflation driven by an energy crisis and those rising utility bills. So in terms of our UK expectations, well, the UK, we think, is already in recession. We saw a contraction in GDP in the third quarter. That was weaker than in the Eurozone. And we've got contractions over the next couple of quarters, such that there are potentially some bigger UK-specific issues than the Eurozone because we've got the energy crisis, the prospect of fiscal consolidation, very high inflation with food prices rising by over 16% year on year, as we saw in yesterday's data, issues with regards to labour supply, potentially some Brexit issues underlying all of that. So there really is a big list of UK economic headwinds, some of those UK-specific and not just global.
But does Brexit really make things worse? And is there any possibility of, reversing some of that damage?
Well, with Brexit, it's really difficult. Politically, it doesn't look like there's going to be any major reversal in terms of the Brexit settlement anytime soon. Now, for economists, the job has been really difficult to try to unpick what kind of impact Brexit has actually had on the UK economy relative to COVID effects, for example. There was a lot of discussion of this among MPC members with the Treasury Select Committee yesterday, and it does seem to be that there is certainly some sort of role with regards Brexit on the UK trade story, possibly some kind of effect on the inflation story, which is particularly pertinent at the moment when we're thinking about the cost of living squeeze. So there is something there and potentially some headwinds which could keep blowing for some time to come.
Chris, as we also think about kind of external factors that authorities in the UK and really economic authorities around the world have to think about, I wonder how you're thinking about China. We heard from the PBOC overnight warning about inflation, saying that a recovery in demand in the Chinese economy could fuel that. And in theory, that could be exported elsewhere. How are you thinking about the China reopening story and how that could exacerbate some of these price pressures that economies like the UK are facing?
Yes, for UK and Europe, the impact of China on the economy is a kind of multifaceted sort of thing. Of course, for a lot of European exporters, this is a good news story. If there's a sharp reopening in China, that could help broader domestic spending in China, but that might also have some spillover effects in terms of the exports that Europe sends to China. But then at the same time, stronger growth in China puts upward pressure on commodity prices, and that might be an inflationary impact. I mean, overall, when we're thinking about the UK in particular, those exposures to China aren't necessarily a first-order issue. But, I think overall, if we're thinking about stronger growth in China, a rising tide lifting the global economy, it should overall be a good thing, notwithstanding the fact that it might create some inflationary pressures along the way.
Chris, thanks very much. Thanks for joining us. Chris Hare of HSBC. And stay with us. We'll bring you coverage of Jeremy Hunt's statement, of course. The UK Chancellor will be speaking to the House of Commons. It's usually a rowdy affair. Plenty to watch for in terms of that UK autumn statement. What will it do to UK assets? This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the principal room. Coming up later today, an interview with Brian Chesky, the Airbnb CEO. That's at 1 p.m. New York time, 6 p.m. in London. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. Let's keep our focus on the UK. The Chancellor, Jeremy Hunt, delivers his autumn statement in the House of Commons today, within the hour, in fact. Joining us now to discuss, Marcus Ashworth, Bloomberg opinion columnist. And Marcus, you've been writing about the difficult choices that lie ahead. You say the government knows it can't risk a repeat of the recent meltdown in gilt. What does it need to make sure it does today to avoid that?
I mean, normally I wouldn't be the type of person advocating austerity when we're clearly in a recession and probably going deeper because of this autumn statement. However, the premium that was built up on gilt assets is so ruinous that we saw, a month or so ago, that they have been allowed by the markets some faith that they are going to correct that and fill the fiscal black hole and do something sensible with regards to getting the balanced budget in at least 5 years' time. So they have to deliver on that. And that means they have to do some nasty things now. They can't push it all out beyond 2025. You were discussing before, past the next election, no one will be spending cuts out then. And likewise, the credibility has to be kept by the market, so they're not going to see just some future measures which are possibly never going to happen. So they have to do some nasty things now. There is some benefit from that because if the OBR recognises it, that feeds directly into the Bank of England's models, and hopefully the Bank of England doesn't have to hike interest rates so much.
OK, so that's the link between the fiscal and the monetary and the way that they might support each other here then, Marcus. So thinking about where this heads next, you've set out why the profiling then matters to you and you think to the markets. What about the level of political support that this budget can achieve? Because there's no point in presenting something that's not going to get through the House. So how will the market be thinking about that?
Yeah, so the cunning balance between doing enough now to get some benefit from the OBR to then get benefit from the Bank of England, and we're completely trapped in this sort of econometrician's black box, falls apart when it hits the reality of getting it through the House of Commons. Now, one imagines that they have got this through in the sense that they've done enough works with the whips to make sure that people will vote. We saw one MP question whether HS2 should go ahead and possibly withhold her support for it. But beyond that, this is going to be a very difficult finance bill to get through, and I think there are going to be some troubles here. Nonetheless, what we want looking for is quite what if they do a bit harder now, how much room that might give them before the next election, late 24, to have done some easing back of this. And that, again, all depends on these OBR forecasts. They all sort of link in a horrible loop. If he gets it right, he'll be lucky. If he gets it even a little bit wrong, it all falls apart, especially if you get a worse recession.
How badly could it fall apart? I mean, I realize you've got sky-high inflation, and Rishi Sunak doesn't even want to give nurses a raise, but the pound has come back to 119 now. Your debt to GDP is very low compared to other rich countries. The duration is double of your debt is double what it is here in the U.S. You got much longer to pay it off. It doesn't seem that bad, Marcus.
Yeah, until you get the fact, the Achilles heel basically of what happened a month or so ago, when everything fell apart really very quickly indeed. And I think a lot of the rest of the world were looking again about, one, how could this possibly happen in a major economy like the UK? Two, could this happen to us? And so the point is they've got to play it very, very straight, very sensibly, no rabbits out of hats, because we have to keep that gilt yield down to a level. Otherwise, the cost of funding is what is going to kill the back end in 2026, 27. The cost of funding is going to add an extra potential 50 billion. They've got to get that down, keep that down, which means the Bank of England hopefully won't hike interest rates as much. So it's a very painful exercise. Things can go very badly wrong. We've seen that. I think the real risk here is that, one, they may not get, the Tory party falls apart again, or secondly, because of that recession, if they overdo it. So I don't know how they're going to balance this, but these are some very clever people. We saw what Rishi Sunak did with furlough scheme. I'm hoping against logic that they find something we haven't all thought of yet, and that somehow the things can all add up. But I'm not sure I've got that much confidence.
Well, Marcus, as we talk about kind of a spectrum of outcomes here, what about the spectrum of inflation? How much could it change in trajectory depending on the policy that Jeremy Hunt outlines today?
Oh, well, I mean, if we hadn't had the Liz Truss sort of blanket energy cap, we would be looking at close to 14% inflation, which rather than the 11.1. So I think, and it's a very bold call, we've probably seen the top of inflation in the UK. And that it might be sort of hanging around here for the next 2 or 3 months, maybe a bit longer. Well, inflation is set to plummet later next year, and possibly by 2 years' time to be one below the Bank of England target and even close to zero. So, the Bank of England doesn't need to do too much more, but they've got to be convinced at 11% inflation that the government's got the government finances in control, so that they can have the confidence to look through some stuff and maybe not hike quite so much.
OK. Thanks very much, Marcus. Very good to speak to you. Linking the fiscal and the monetary. Bloomberg Opinions, Marcus Ashworth. Thank you very much for joining us. Just want to take you through a few lines we're getting from Rishi Sunak after the G20 in Bali, talking to the House of Commons ahead of the fiscal statement today, saying that China poses a significant challenge to our values. Also talking about trade deals, saying that he won't sacrifice quality for speed on trade deals. Perhaps that's in a reflection of some within his party who've criticised his predecessor, Liz Truss, for perhaps setting deadlines around trade deals, which didn't necessarily work in the UK's favour. That's the UK Prime Minister. More from the Chancellor shortly. This is Bloomberg.
We would really want to hear that the perpetrator country is the Russian Federation. We would be happy if the speed could be named speed.
China and the United States, as two major countries, both stand to gain from cooperation and lose from confrontation.
We're at the beginning of a bridge-building effort.
As we look at supply chains around the world, they were fit for 20 to 30 years ago.
The central banks misread the signs. They misread the risk of persistent and much higher inflation.
My team, for choice, thinks 2023, we avoid a recession. I'm a little more skeptical.
We're going to have new and improved data access protocols such that only an entity of U.S. residents that in the U.S. will have access to a certain set of U.S. protected data.
Crypto industry has been cut to ribbons this year. It's just too risky to sit out with a bunch of cowboys who have managed to blow themselves up.
That's just a few of the highlights from the Bloomberg New Economy Forum that took place in Singapore this week. Now let's get a quick check on what is coming up ahead on this Thursday. Alibaba will be reporting its earnings results at 6:30 a.m. New York time. Plus, retail earnings continue with Macy's reporting before the bell. On the economic data front, we'll get some here in the U.S., including housing starts and building permits. And finally, we'll hear from more Fed speakers, including St. Louis Fed President Jim Bullard and Cleveland Fed President Loretta Mester. But as we all have our eyes on monetary policy, we also are watching fiscal, especially in the UK, as we await the autumn statement from Jeremy Hunt in the next hour. Let's get over to our markets reporter, Valerie Teitel, who has taken a look at the implications for the gilt market. Valerie?
Yes, thanks, Kailey. A key thing for the gilt market today will be the update from the Debt Management Office on the gilt remit, which is the issuance they expect for this year and next. Now, interestingly, the survey estimate from Bloomberg that we conducted only showed a 5% decrease in the issuance versus in September. Now, remember, these September numbers were shocking for the market. It was near $200 billion of expected gilt issuance this fiscal year. And so the market has only really taken that down by 5%. We're still expecting a lot of issuance this year and next. And Citi, specifically, the strategists at Citi actually expect the number to be elevated over the next 2, 3, 4 years. Now, one might say, well, given these estimates are still high for gilt issuance, why have gilt yields retraced so much? But, you know, this is coming at a time where there's been two key things that have changed. The UK their terms of trade have rebounded sharply. So that massive hole in the current account deficit we were worried about, we're no longer too concerned. And also, the U.S. inflation data looks like it's cooling. That's allowed the dollar to soften, treasury yields to lower. So it's a much better time to be confronting the market with this issuance. But if what Citi says, for example, is correct, that it's not just this year of the issuance, but the next 2, 3, 4, you know, the UK government still has to tread quite carefully when they approach the market with these issuance numbers.
Valerie, thank you very much. Bloomberg's Valerie Teitel there. And Kailey, interesting point then from Valerie in terms of the global backdrop in bond markets to what the UK is doing here, trying to regain that lost credibility with debt markets, with gilt markets. And the backdrop globally is more conducive to doing that, it seems. Although, when you look at markets today, we seem to be back to worrying about some of the things we were doing before we saw a rally in risk assets, worrying about Fed tightening once again, worrying how long it goes on for and where it gets to.
It always seems to come back to that, doesn't it, Anna? When at the end of the day, we're trying to assign a narrative to the market action, it's always like, oh, well, the Fed and what those speakers are saying. So we'll definitely have to watch for that today. But we are seeing futures right now at session lows, down about 0.5% on S&P E-minis. The 10-year yield right now, Anna, at 3.73.
That is it for Early Edition. That's it for Matt Miller, Kailey Leinz, and for me here in London. We will leave you with the surveillance team. They will be bringing you coverage, of course, of the autumn statement here in the UK. Lots more to talk about on the markets as well. This is Bloomberg.